Hi everyone, my name is Andrey and I'm a loan officer in Fresno, California. And as a licensed loan officer in the state of California, I have clients and friends and family throughout the state asking a lot of questions about applying for a mortgage to buy a house, first-time home buyer questions and all of that. And so since we are sheltering in place right now because of the whole circumstances in the world and in the States, I've got a little bit of more time to answer these questions, and so I've decided to make some videos, and hopefully it's going to be helpful not only to my clients and family and friends, but to everyone looking to buy a house. Today we'll be talking about down payments, and specifically, is 20% down payment required when you are trying to purchase your first house? The short answer is no, it's not. There are loan programs that require less than that. There's an FHA program that requires 3.5% down payment, and there's also a conventional program with 3% down payment. But let me give you a more broad answer into this question and provide you with more details. Anytime you put less than 20% down payment, the bank views your file as more risky, and so they require you to purchase mortgage insurance. In case you default on a mortgage, the bank will be protected. With 20% down, you are less risky to the bank, and so they don't require you to purchase a mortgage insurance. So let's take a look at these examples and comparisons between 20% down, 3.5% down, and 3% down, and see the differences and compare them and look at the pros and cons of each of these. So with 20% down option, let's say the purchase price is $250. All right, in Fresno, our median sales price is about $269, $275, but for simplicity, let's take a look at the purchase price of $250. If you want to put 20% down, that comes out to about $50,000 to $50,000, right? So with that, your loan amount is going to be $200,000. 250 minus 50 is $200,000. Let's say you can get a rate of 3.75%. With that, your principal and interest payment per month is going to be $926.24. And since you put 20% down, you're not required to buy mortgage insurance, so your mortgage insurance is zero. And your total payment is same as your principal and interest, $926.24. Now let's take a look at interest that you will pay over the life of the loan, let's say 30 years. What will you pay in interest on $200,000? Your interest paid over 30 years is going to be $133,443, so about $133,000 in interest. You will pay off your $200,000 to the bank, and on top of that, you will pay $133,443 over 30 years. And you will pay zero in mortgage insurance, okay? Now let's compare that to an FHA loan with 3.5% down. Same example, same purchase price, $250,000 at 3.5% down payment is $8,750. As you can see, the down payment is a lot smaller than with the 20% down option. Your loan amount is higher, $241,250, because you put less down payment. And let's say the interest rate is the same. The interest rate will be different, but for the illustration purposes, let's just say that the interest rate is the same, 3.75%, okay? Your principal and interest comes out to $1,117.27. And since you put less than 20% down, you are required to pay mortgage insurance. And on an FHA loan of $241,250, your mortgage insurance comes down to $169.34. 36. So your total payment is going to be $1,286.73. Okay, now let's compare that to the 20% down option. So you see that principal and interest is higher because you have a higher loan amount. You also have mortgage insurance, where here you don't have mortgage insurance. And so overall total under this option is higher than under the 20% down option. Okay, now let's take a look at the interest paid over 30 years. Here, $160,965. Almost $30,000 more you will pay in interest under this option, and you will also pay mortgage insurance. Now, most of the people with FHA loans, they will refinance down the road, they will refinance to a conventional loan, and they will get rid of the mortgage insurance. But let's say that you will stay in your house for 30 years and you will pay your FHA mortgage for 30 years. How much in mortgage insurance you will pay over 30 years? That comes down to $60,969. So you will pay $160 in interest plus $60,969 in mortgage insurance. Okay. Now let's take a look at the conventional option with 3% down. Okay, same example, $250,000 purchase price at 3% down. That's $7,500 as a down payment. Your loan amount is $242,500, right? Purchase price minus down payment. That's your loan amount, how much you borrow from the bank. $242,500 at the same interest rate, 3.75. Your principal and interest is $1,123.06. Your mortgage insurance on the conventional loan depends on your credit score and depends on the down payment. But in this example, your mortgage insurance is going to be 101.04. So your total payment is $1,224.10. Okay. Interest paid over 30 years is going to be $161.799. And mortgage insurance on conventional loans is about, you will pay that for about 10 years and it will be dropped off, or until you reach 22% equity in the house. Okay. So let's say you've paid your mortgage insurance for 10 years and that came out to $12,124. Okay. So as you can see, 20% down has some pros and cons, and these options have some pros and cons. What are they? Okay. Well, the benefits of 20% down, first is you have a lower monthly payment, you have a lower mortgage, and over the life of the loan, you will pay less in interest. Okay. But what is the disadvantage of this option? The disadvantage, as you can see, is the down payment, the amount of the down payment. It may take you a long time to save up $50,000, $60,000, $70,000, depending on the purchase price, but it may take you years to save up this for down payment. Okay. Versus if you look at the FHA or conventional with 3 and 3.5% down payment, the advantages is that you only have to come up with $8,000 for the down payment. So your out of pocket is less. You can buy a house sooner because you don't have to wait until you save up 20% down. The disadvantages, yes, you would have to pay mortgage insurance, and of course your monthly payment is going to be a little bit more than under 20% down, but you can buy a house now or sooner than later with 20%. Okay, so as an overview, it is not required to have 20% down. You can buy a house with 3.5% down, with 3% down. It just depends on what feels right for you. If you have the opportunity and if you have the means to save 20% for the down payment, you should go ahead and do that. If you need to buy a house sooner and you don't have the means and opportunities to save 20%, then you have an option of less down payment and buying a house sooner, okay? So if you have any questions, my contact information is going to be on the screen and in the description of this video. Feel free to call me, text me, email me with any questions. Leave some comments and leave any questions that you would like for me to cover in the future videos. I'll be happy to do that. Share this video with your friends and families and those who are thinking of buying a house. And that's it for today. Thanks for watching, and I'll see you next time.